In our last episode, we walked through the top half of BrightLeaf's balance sheet, the assets, everything the business owns. We added it all up and found that as of December 31st, 2026, BrightLeaf owns $751,783 worth of assets. The cash, the receivables, the inventory, the equipment, the furniture, the building. But we left a question hanging. Where did the money come from to pay for all of it? It didn't come from thin air, it had to come from somewhere. So in this episode, we'll continue our examination of the balance sheet, picking up with the liabilities and then turning to the equity, which together will tell us exactly how BrightLeaf funded everything it owns. So let's begin with the liabilities, everything the company owes to others. And just like the assets, these are split into current and non-current on the very same principle. Anything owed within the next year is a current liability, and anything beyond that is non-current. So let's walk through the liabilities. First, BrightLeaf has $10,000 in accounts payable, which is the mirror image of accounts receivable we saw last episode. Where receivables was money owed to BrightLeaf, payables is money BrightLeaf owes to others. This $10,000 reflects goods or services BrightLeaf has received but not yet paid for. Maybe their coffee bean deliveries come with terms that payment is due within 30 days, and BrightLeaf has accepted a delivery it hasn't paid for yet. Then there's $8,000 in wages, payroll taxes, and benefits payable. This means that as of the balance sheet date, BrightLeaf's employees have earned wages and benefits that haven't been paid out yet. BrightLeaf likely pays on something like a bi-weekly schedule, so there will always be some earned but unpaid compensation at any given snapshot. Now in the real world, a company would probably break this into separate accounts, one for wages, one for benefits, one for payroll taxes, but that depends on how the accounting team wants to organize things. For our purposes, combining all the payroll-related obligations into one account is a reasonable way to present it. Then next is income tax payable of $18,000, which is tax BrightLeaf owes but hasn't yet remitted. And finally, you'll see $2,909 listed as the current portion of long-term debt. And that's a nice segue into the non-current liabilities, because that current portion is really one piece of a bigger picture. BrightLeaf has a loan, and when it comes to the principal due on that loan, $2,909 of it is due within the next year, so it's classified as current up here. The remaining $132,054 isn't due until more than a year out, so it sits down here in non-current liabilities. It's the same loan, simply split by when it comes due, the near-term slice up top and the rest below. Now, as I said, BrightLeaf has a loan, but the truth is, just looking at the balance sheet alone, we can't be certain whether this is one loan or several. And the statement doesn't tell us anything about the nature of the obligation either. What's the interest rate? Is it fixed or variable? When exactly is it due? These aren't questions we'll dig into here, but I do want you to file them away. Because right at the start of this series, we said that complete financial reporting includes the 4 primary statements and the notes. And this is a perfect example of why the notes matter. They fill in exactly this kind of detail that the primary statements alone can't convey. We'll cover the notes in time, but keep noticing the places where you find yourself wanting more detail than the face of the statement provides. So back to the liabilities on the balance sheet. Let's total them up. BrightLeaf has $38,909 in current liabilities and $132,054 in non-current liabilities, for total liabilities of $170,963. So now we know that of their $751,783 in assets, BrightLeaf funded $170,963 through borrowing, through other people's money. A little of it from suppliers, a little from employees who provided services before being paid, some from the government in the form of taxes owed but not yet paid, and the majority from a bank loan. So if borrowing funded $170,963 of the assets, the rest must have come from the other source, the owners. And that's owner's equity, the final section of the balance sheet. Remember, equity is the business owner's share, everything left over after you take all the assets and subtract all the liabilities. And BrightLeaf's equity is made up of 2 pieces. The first is common stock of $450,000. This is the money the owners invested directly into the business to get it going, the cash they put in exchange for their ownership stake. Most likely, the majority of this happened right at the start of the company's life, before it even bought the building. The business needs money to purchase that building and everything else required to open the doors. And at that point, it had no earnings yet and limited ability to borrow from a bank. So it appears, based on the figure as of the end of 2025, that the owners put in $400,000 to fund the launch, and then another $50,000 was invested during 2026, and filed that additional $50,000 investment away for when we get to the statement of equity in future episodes. Then the second piece of owner's equity on the balance sheet is retained earnings. You'll notice on BrightLeaf's statement, it's actually presented as two lines, a retained earnings line and a current year net income line. These are really the same bucket, just shown separately. Past retained earnings on one line and the current year's profit on another. Many accounting systems present it this way, so we'll show it this way too. Taken together, BrightLeaf has retained $130,820 in earnings over its life. Combine that with the $450,000 the owners invested, and total equity stands at $580,820. And now we have the full answer to the question we opened with. BrightLeaf's $751,783 in assets were funded two ways. $170,963 borrowed from others, and $580,820 provided by the owners. And of course, those two funding sources add up to exactly $751,783. The equation holds. Everything BrightLeaf owns is fully accounted for by where the money came from. That's the balance sheet, top to bottom. But I did cover this retained earnings account quite quickly, and didn't quite give it the full discussion it deserves. Because that retained earnings account is the point where the income statement and the balance sheet directly connect to one another. So in the next episode, we'll look at how profit flows from one statement to the other, and how these two reports work in tandem to tell a larger story that neither can on its own.